Alright, hello guys, and glad to have you on board again today. I feel like it is an appropriate time to update on an intraday basis, have a look at what happens, and I've been remaining pretty silent about the indices and all of the sectors and asset classes. But I think it's an appropriate time to update, even though there's not that much to trade actively in the short run. We're just going to have a look at it still. Also, I am going to release a massive 1 hour long kind of video on Cosmos ecosystem today, after releasing one about Chainlink. So this will be probably the end of the educational series that I wanted to plot at the early stages of 2022. So we'll be done by the educational series, and right after this one is terminated, I will finally get a start at re-recording the trading lessons and terminating the presentation stuff. So getting right back at the strategy, technical, and educational content right after these 2022 years projection series will be terminated once and for all. Okay, still, go back to the market right now. So in terms of Bitcoin, if you look at the on-chain data, I've received alerts on speculative leverage yesterday once again. But if we look at the open interest and the speculative position on different exchanges like Binance, traders are net short, which is still concerning in my personal opinion, because like I've always mentioned, there is no short selling activity that's worth it below 46K. And in that perspective, I'm very well questioning whether we're going to get that short squeeze at some point, because we still haven't got it. I've seen some people saying, oh boy, shorts have been squeezed the hell out. Well, definitely not. Just look at the data. Absolutely no short liquidations suggesting such a thing happened. So when you put out some kind of a hypothesis like that, look at the data, otherwise shut the hell up. So it's definitely not the case. No short squeeze so far, leading me to believe that maybe this will happen. This is not a certainty, of course, but something to bear in mind. Okay, so in the short run, nothing too fancy to talk about. Like I've said, the V-bottom structure puts itself into motion. We have failed to break any cycle, meaning that we are in a bullish cycle. It's just a very late one, meaning that the indicator thought we would be bottoming out of the 44K level, and we've just extended the bear run to flush the thumbs and weak hands below 40K. Still, at that point, I think we're going to recover those levels one by one. Look at the weekly updates if you want to know more about that. In the meantime, remember that the resistances tends to be around the technical trend channel, which means I don't see any reasons for us to work out this area efficiently. It's just going to be short-term risk limitation and management. Basically, to put it straightforward, it's all about volatility. So if you go into the shorter time frames, the reason why the market is kind of trying to change pace in the short run isn't because of short squeezes or whatever. It's just because we're dealing with volatility boundaries. So understand that that means the prices have risen very quickly, and then in that perspective we're going to have to slow down. That doesn't mean we're going to get any such a thing as a reversal. We could reverse to the mean and going back up, or we could just stay there and slow down the momentum. Understand that what we're dealing with now is volatility boundary limitations, and they certainly do not mean any more than that. You have to understand that I teach you how to efficiently trade volatility at the risk limitation once I actually told you how to efficiently understand range and trends management and all these things. So one very quick thing, if you ever intend to trade volatility boundaries when you're actually in the big middle of a fucking big range, like we do on 4-hour chart reference, daily chart reference, well, good luck on trading volatility at the middle prices of a range. This is definitely where you're going to get fucked up by the market makers. So understand that this is a market maker perspective kinds of things, and therefore, well, let it happen. I don't think there is no such a thing as bear potential anymore, just like I think there is no gas to keep accelerating in a short run, but to go liquidating the bears. So there's only one way up, it's to go for a liquidation stuff. But that doesn't mean it's going to happen. We have all the necessary ingredients, don't get me wrong, but that doesn't mean it will happen. We are at volatility boundaries, so this is definitely not the appropriate amount of time to go for bull trades, okay? So no buying, no selling, just let it play its game. It's what needs to be done in the crypto market now. What does that mean for altcoins then? Of course, this is where the big battle for the KShape recovery will play its game. All of the assets have been slaughtered recently in the altcoin stuff. And like I've always said, they are 80 or 90% of shitty assets that will die within the next couple of years. But instead, there are a few assets that have been slashed as well and bought by the smart money. So now that they bought, understand that these guys probably bought for weekly to monthly chart reference timeframes, which means they do not give a fuck about the short-term resistance we deal with. So this is where you're going to be able to see the first, where does the smart money takes the profit, where does it does not, where do we rebounce very quickly, meaning that there is very little interest in these markets. This is what I pay real attention to, okay? So we're in a range, so this is range price action assessment. This is really some professional stuff. So please don't try to overthink things now. Understand that as long as we're dealing with the ranges, the one that rebounds fast are not necessarily the best ones, okay? It's really much more complex than that, and we're going to have to work out the entire range structure before thinking about such a thing. We need to figure out where the third range boundaries were, okay? So look at it. Where did the third range boundaries put themselves, and how fast are we going to get to this on each and every asset? Once we get to that area, how does the price react? Because if the prices are surging right back up to test the previous third range boundary and reject them, that just means one thing, that we're going to extend the range further down in the time. It's certainly not going bullish. So those who recover fast are not necessarily the best ones, okay? This can be very, very, very misleading to some of you guys. I'll let you know anything I have to tell you about when I have information. Right now, nothing needs to be said about who's the strongest or the weakest. It's just short-term volatility management. Let the market makers do their job. Okay, when it comes to stock markets, because I haven't been talking about them for a while, doesn't mean they weren't interesting, but just means that I don't care about these areas, because I think in order to buy, like I said, I think we need to go lower. But I've also said you do not want to short bet on the market. It's way too dangerous, because it was entirely correlated to the earnings seasons, and we had kind of contrasted one. Some of the headliners have been entirely fucked up, Facebook not to name it, but there was also Netflix. Lots of big names have been disappointing, but lots of others have been surprisingly positive as well. So the one I was paying a lot of attention to was Apple, to see how good it would be, because I didn't nearly thought it would be bad. So it was good, but not that good. Remember that what we pay attention to is the rhythm of growth, the growth rate, and the growth rate is definitely slowing down 2 quarters in a row for Apple. So not the end of the world, but concerning for the momentum. As this is a bubble, things need to keep accelerating constantly. So we'll see about that, but as Apple positively surprised, and Amazon as well, it compensated for the others who have been pretty bearish in this stem. So, of course, the indices who are no more than showing you the GAFAMs. Remember that when you look at the S&P 500, which is supposed to show the US GDP in general, or 85% of the GDP, well, 35% of it is just the top 10 stocks. So remember that if you pull them out, you would have a totally different story in front of your eyes. So the S&P 500 is no more than a cheat sheet of basically looking at the top 10 stocks. So until then, I only use it for cover trades, but no more than that. And remember that if you ever short sell the indices, it's because you have bullish exposition on your portfolios. Don't short sell the market otherwise. There's not going to be a crash or whatever. Very less likely. Okay, then when it comes to US WTI, we've got some interesting signals over the latest couple of days, and I really questioned them because the algorithm detected, we'll try to accelerate, but we all got just but a taking profit pattern, which means, well, this is not the best case scenario to go short on WTI. So in that perspective, I think we can work our way out this area, eventually try to go a bit higher, but anyhow and anyway, I think we're pretty much nearing the end of that pattern. Just like the first taking profits in here, I've been taking a few weeks before processing the downturn reversal. I think this is the exact same pattern that may play its game. I think we're right back down to the same level once again. So this is kind of a weird pattern in which we're going for extended wedge pattern like that. These are very rare technical patterns, but this is what I think is happening now with the WTI. So same old thing, wait and accumulate at cheap prices, but WTI is to be bought. If you ever try to sell it, it's only because you are hedging against something. My shorts on WTI are hedges against some other things in the portfolio, and I know that I can be wrong with these ones. Okay, what I pay attention to mostly now is the Dixie, because of course Dixie has been made its huge reversal, looking for the volatility boundaries that we've mentioned, and this is clearly a volatility rejection. So what we'll get down there is that we can work our way back into these previous supports, but it could take more or less a few days, weeks before we actually push through, and when we'll actually finally break this trend line, everyone will start figuring out that this recovery bullshit was just nothing but recovering the weekly bearish momentum. And in that perspective, oh boy, we'll finally see that the next support in line is this one, and that it's weak as well. So remember that if we reject this area, there's nothing to hold us back until we get to 90. So it's all about losing 6% in the dollar. Not the end of the world, but 6% on a forex general market is something. And what I like is that this 6% mark is kind of something that we see everywhere. But the WTI, I think this could support the WTI in this area. I certainly don't think the WTI is going to take an additional 6%, but it could do it eventually. What I think of this is mostly that I find the same 6% mark when it comes to pricing up the the gold. So I think gold has been working around this area for way too long. Really has been kind of a neutral range. So normally we would have no problems getting into trade above the resistance context. So I think gold could get into the speculative area around and spilling around $2,000, but I don't think we have the strength to actually seriously break through this. So like I said, I think it's going to be kind of a cheat sheet in which basically the dollar surges down, in which of course we've got a huge breakout in the big middle part of the range. But remember that when we break middle range areas, this is normal than things to catch up the dumb money. So it will probably be quick, so that we'll rapidly get into the resistance territory to let the dumps buy, and luckily I think the smart money is going to sell the shit in front of them. So remember that we're very likely going to visit those two areas in the short run, or within 2022, 2023, due to the huge dollar's volatility in the background. So pay real attention to this. It's not guaranteed, but if the dollar goes down, well, I think gold could severely reach out to resistances, but it's not going to be a buy point, okay? So be cautious. Where I think is going to be more interesting to look for is if the silver does the same thing, because silver has way more than 6% to offer. And silver has been working around a much more technical range structure, in which I think that if you do want to see an horizontal resistance in here, I would be okay with that. But remember that anyway, you never sell below the 50% context line. So I think that this is where we could go. So way more than the 6% gains that the gold could make. So I don't know what could spill out a surge in the silver prices that could not be replicated as big in the gold. But, well, this is what I see in prices. Silver has been pushed down way more severely than gold, though in that perspective it may have a catch-up effect, but this is serious gains to talk about. We're talking about a 30% or a 25% up move in the silver to get to resistance territory. So if dollar devaluates for some reasons, I don't know what the catalyst could be, but gold and silver could be beneficiating it. Gold seems to be the safest option, but of course will bring far less rewards once we reach out to the resistance territory. For the same amount of risk taking, of course silver will be far more volatile, but that also means that if the losses are to be taken down, well, silver has absolutely no supports down below. So if both of them were to go in the wrong direction, well, silver has no grounds. It will go into uncharted territory trying to build a support out of nowhere. Though trickier thing to navigate. If you want to make bigger gains, silver is great, but it also requires better tight risk management on your end. So I would say for more experienced traders, silver is going to be the one to opt for. For those who lack of interest, well, you can buy gold, but be aware that you have as much gains as losses to make. But if you're patient enough, you need to understand that as there is a trend, we'll have to get through the resistance territory. So even if you get wrong-footed, I think this is not an opportunity to say, okay, I was wrong, I take a stop loss. But more to say, I have 50% of the trade in here, and I'll be willing to put 50 additional ones if we go for the bullish area first. Okay? I think anyhow and anyway, we're gonna see a gold at $2,000 this year, or at least getting close to it. The question is just, are we going to do it now by the dollar devaluating after rejecting the volatility boundary, or are we first going to go wrong-handing and wrong-footing the speculative hands before going it anyway? Okay, it's a matter of how, not if, in my personal opinion. So watch out for the dollar. It's really the thing that is playing the game right now. And as it rejected the volatility boundary, well, I think we can still work our way into these areas for extended amounts of time But the huge rejection and bearish engulfing closed that we have last week, not a good sign in the short run. So it could start anytime now. We are starting the bear cycle and we already have a bearish momentum. So like I said, it could go faster than you think. It's not an appropriate time to say, oh, maybe the dollar is going to be strong. I think dollar is going to weaken over time. It's not necessarily going to be immediately, but this is something to bear in mind. Once the dollar starts breaking daily to weekly supports like this, like I said, no supports until then. The moving average is bearish, the trend channel is bearish, so there will be no supports until we get to this trend line, which is weak the fuck as well. And the underlying technical supports are not going to show up until an additional 5% drawdown. So there is 5 to 6% down movements to make on the dollar without a single support in between. Of course, then we'll get technical risk limitations, so we're going to have to range a bit. But once we break this old trend line as well, this is an additional 5 to 6% deterioration that's going to show up. So yeah, dollar has some grounds to lose, and this may support our cryptos and all of the other assets that are dollar stamped. Until then, watch this one carefully. See you guys later.